Before we jump into the resources, though, and thank you for the background. You're an interesting person. I also wanted to sort of get your idea on how you view the macroeconomics, global politics, stuff like that. So let's say I have no idea what's happening in your field of work, and I'm not following economic news and something like that. How'd you brief me on it from sort of a 40,000 foot view? And I guess without you having me sort of freak out and run to build an underground shelter, because if you look at what's happening in headlines, you might want to go and do that. So how'd you brief me?
Well, I don't know if you're going to go in an underlying shelter, but I don't think you're going to pop a champagne and celebrate what I have to say. I turned extremely bearish by the end of 2021. My simple comment was that I felt for America, which is mostly what I follow. I'm not a world market follower, but for the United States, I felt we entered the worst ever social, political, and economic era. And there, part of the reason is also around the world because of the amounts of debt that we have. America's been robbing Peter to pay Paul, which is a saying in the States, and it's tapped out. You know, I never imagined when I entered the business that I would ever use a word that began with a T to describe debt levels. But we now have 30 something trillion. We even have $1 trillion deficits. And with what's happening here, our CBO, Congressional Budget Office, says we're going to add another 19 trillion the way we're going onto that debt over the next 10 years. We'll be at $50 trillion. There's a great argument that one can make that we will have much difficulty just paying the interest on what's owed. And while that's happening, we also have simultaneously, and again, it's happening around the world too, but we have what I call a very budding retirement crisis. Almost three-quarters of Americans now are working paycheck to paycheck. And in the last 12 to 24 months, because of our inflation, they've had to use credit cards to pay for necessities, not luxuries, necessities. So they don't have any real chance of saving for retirement. And they're going to get to a point where either they're going to have to work well past an age they thought of and or look for the government to assist them somehow, all at a time when, as I just noted, we're in terribly debt shape. But what's really poor in the United States is our political system is all but broken down. Both parties don't dislike each other because I think if you just dislike each other, you could actually do something together. They absolutely hate each other. And so this is the most dysfunctional Congress I believe we're going to have. And it's coming at a time when some really critical issues have to be dealt with, and it's not. And we're also seeing the United States dissipate its influence around the world. Just in recent weeks, we've seen dramatic developments in the Middle East, BRIC nations coming together and talking or starting to trade without the dollar. Uh, the Ukrainian war, which was seemingly favorable one way and now is kind of turning. And of course, what's taking place in the Middle East and what China is doing in a role that might have been just exclusive to the United States not too long ago. So all those things don't have, to me, beneficial for our investment markets here in the U.S. And it's very difficult to make an argument that we can continue. But we have a problem here in the U.S. We have a financial service industry, which I've coined the "Don't Worry, Be Happy" crowd. And you could toss them off the top of the Empire State Building and all the way down. They'll all say the same thing. Hey, so far, so good.
Mm.
And the problem with that is it was that way for quite a while. By dramatically lowering interest rates to zero, other than killing our fixed income market, the Fed created a Kool-Aid, and with a professional community on average in the business 15 years or less, they basically learned to drive on a one-way street, put the pedal to the metal and go. And that's who people are going to be seeking experience now that the fact that it's clearly at least a two-way street, if not a bunch of roundabouts or traffic circles, depending on where you're on the world, what you want to call them. And so I just think there's a whole mirror of issues that make it very difficult for general equities not related to natural resources to be beneficial and to expect any type of gains that people grown accustomed to. And one other add to that is, since a lot of people, what we call the baby boomers, have reached retirement, maybe retired a few years earlier, or look in the next few years, they have been heavily invested in general equities to reach those retirements. Last year, the average retirement account in the US lost 25%. Throw inflation on that of 10 or 15%, and they're kind of behind already. And if the market doesn't recover and start going back up the way it used to, these people's lifestyle are going to have to change, and not for the better.
It's funny that you should mention the words with the letter T, because it seems like that's definitely sort of the topic of at least my generation that's entered the market, because we had transitory mentioned a couple of times. We had tech companies going in trillions in valuations that made sense for nobody. There's other T words that are a little bit more political right now that maybe we shouldn't talk too much about. But it really seems like it's the theme of the party here is stuff with the word T. Let me ask you about another word with the word with the letter T. Terminal. Do you think the dollar is entering terminal decline as we speak?
Yeah, it's reached its zenith in the beginning of the interest rate rise. What is happening geopolitically on so many fronts is clearly the beginning of the end of it as the world reserve currency. Now, I don't know how long that'll take. That could still take years. That's still possible. But it's more has moved against it in the last few weeks than it did for the last few years. And it seemingly is building up steam. And so with that, and with, I think, here in the U.S., an administration that's not loved, not just here in the U.S., our president has very low polling, but not very loved around the world, other than maybe with a similar person like he is to the north of us, our Canadian friends. There's not a lot of people lining up to defend American ways and so forth. And like I said, all of this is very hard for the typical financial advisor in the U.S. to take and grasp, because they have not spent time to understand it and educate themselves to these factors. And here in the U.S., financial advisors, and I don't want to skip into something, but I think it's important to note, they treat gold like kryptonite. They won't go near it. And the amazing thing about that is, as a fiat currency, which is your main livelihood, is clearly somewhat under attack, or clearly is going to have difficulties. And yet the one thing that you can have that's 180 degrees opposite that, which is gold, there's still no one really making an argument in the mainstream media, financial media here, or among financial advisors. And I tell people, you should own it because you hope it don't want to go up. And they always say the same thing. Why do you want me to buy something that doesn't go up? Because if it does go up, especially a lot, your financial assets went down. And so I think a lot of Americans are still unprepared for all of some of the things we just discussed and the changes that are afoot.
I'm curious about where the dynamic of other central banks not buying U.S. treasuries as heavily anymore would lead us to, given the state of the dollar as a reserve currency might be, as you suggested, crumbling. So where does that come in play in your view of the macro?
Well, we've already seen, like, Russia and China have had dramatic drops of ownership of U.S. treasuries. During the quantitative easing, the Fed was as much as 70% of the buyers of our treasury, which is a sophisticated Ponzi scheme as far as I'm concerned. But they're not the worst at it. In Japan was basically 100% of buying their own bonds. So that's another reason to be concerned about dollar. And what isn't talked about yet is if and when, and it's still if, not a certainty, but if and when the U.S. loses the role of reserve currency or gets greatly diminished, where are all those dollars that were currently parked outside the U.S. because it was the reserve currency and you had to hold some? Now, if you don't have to hold them, they're going to come back here, and it's going to create a very large inflation because we're going to have so many more dollars that are flushed back into the system, so to speak, instead of being parked. So there's a lot of negatives and really no positive if the United States dollar loses its world reserve currency. And always keep in mind, even though it takes several hundred years at times, there's always been eventual changes of certain countries and their currencies being, the world, dominant money.
Mm-hmm.
Before us, it was Great Britain. And by the time World War I was over, they couldn't pay their own bills. So, United States is going down a similar road, in my view.
Mm-hmm. I tend to agree where they would start by sort of global powers get built on exporting inflation. That's the whole trick. It's a trick. It's really a trick, exporting inflation. But sooner or later, that inflation has to come back, and you have to start importing inflation that you didn't want to have. Now, I'm thinking about whether maybe this time this empire figured it out, as in China still owns a lot of treasuries, right? So they don't want to dump them all at once because that's going to hurt their own balance sheet. Other countries own a lot of treasuries too. So surely it could take decades before the US really starts importing inflation to a point where it's really noticeable. Does that make sense?
Yes, but there's been a significant decline of that ownership, especially with China. And the other concern that, everybody has is, are we going to even be able to pay the interest? I mean, if you think about it, within 10 years, according to our Congressional Budget Office, which is probably a more independent group than on one side of either party, at 50 trillion and a 5% interest rate, we'd have $2.5 trillion in interest expense, way over half of what we take in our best years in tax revenue. And that would be just to pay interest. So how the United States could pay other things, defense and all that other stuff, it's an impossible task. And again, most investors are not aware of this because most of their financial advisors either don't understand it, don't want to know it, or if they know it, they don't want to share this because it's not a pretty picture and it's still a few years off. And one thing that's changed over the 39 years I've been in the business, people's outlook or what they would call long term has greatly shrunk. When I started, every research report had a 3 to 5 year target. The most you ever see now is 12 months.
Mm-hmm.
And the way our corporate world to benefit by their stock options and all, most CEOs started to focus more on quarterly results because they were being held their feet to the fire by Wall Street. And so they sacrificed doing things that might have hurt now, but could have made the company better a few years down the road. So, like I said, it's very hard to make an argument to want to have a large general equity portfolio. That's not to say that if they fell 30 or 40% and got back to where I think they'd be worthy again at our pandemic lows, then valuations, I think, could be worthwhile despite the issues we have, but not at the levels that they trade at this point.
Mm-hmm. The things that you're telling me here make sense to me when you're talking about in terms of analysis, but how do you, like, what instruments or indicators would you be looking at to sort of determine that the situation is going to start worsening quicker and quicker, sort of a snowball effect? Because, well, let me tell you why I'm asking this, is because, you go out to eat or you pass through the shopping street, go to the mall in the capital here in Belgium or whatever it might be. It sure doesn't feel like most people know that there's just something wrong. I mean, everybody's spending like it's their last day on earth. So when do you think the recession or the troubles will become apparent in the real economy, are going to start hitting average Joes like me?
There's only to a certain level that you can borrow enough or charge up enough. And we're seeing that now start to break in the US. We're seeing delinquency on auto payments, delinquency, some troubles with mortgages. We've just had, which I thought this morning as you and I speak, Blackstone has now froze again one of the biggest real estate investments trusts in the world for people to take money out. And that's because they don't want to have the same problem our banks had where they suddenly had to pay out more than the assets that they had. So I see the handwriting on the wall, whether or not individuals are going to go and say, hey, what, I don't care. I owe so much. Let me go spend some more. Maybe we're at that level. But I know here in the States, I know based on statistics people can only go to a certain level because we have studies that show they don't even have $1,000 saved for emergencies. And look what happened in the pandemic. Within a week of shutting down, they had to create all sorts of money because so many people could not go 3 or 4 weeks without working or an income. So it's an accident waiting to happen, and the accident is coming together. And like I said, it may take days, weeks, or even months, but it's coming. It's unavoidable now. It's kind of like there's an old movie called Failsafe where the pilot was trained once they go past a certain point, they don't turn around. No matter what they say, and if it's supposed to be the president tell them to turn. And we're past that point of no return, as far as I'm concerned.
So even QE on steroids is not going to save us.
Yeah, I think what will happen with that is there'll be an initial, because when you were drinking Kool-Aid and having a party, someone takes it away, and now they bring it back to you. Well, you're just so happy to drink again, you don't think of the problems it causes. But I think the difficulty is going to be is you're not going to be able to get away with what you got away with last time in the way that the Fed printed. In fact, we didn't have an inflation problem. One other change I need to make a point of. When I started in the business, the United States was the world's largest creditor nation. Long gone with that. And when Americans here spend beyond their means, I have a planning group that I'm part of, and I dealt with wealthy athletes making tens of millions, and I dealt with average working class people, families. And no matter what they were, 7 out of 10 of them lived at least one lifestyle above their money. And the only way you can do that is to borrow. And so many came in with significant debt levels, even though they were making a lot of money, or much more expensive cars sitting in the driveway that cost them more than one that could have cost a lot less, and they wouldn't have to be paying payments on it all. And it's just become a way of life, but that way of life is coming to an end. There's no doubt in my mind. And it's not beneficial, just so you make this point. When I speak this way, 8 or 9 out of 10 people that came in to see me want to get out, just want to leave. I hear this so many times. I know you're right, but I'm going to pray you're wrong, because people don't want to face up to this. This is not an easy thing to deal with, to know that it's coming. And so from a financial standpoint, in terms of a business, it's not profitable. But a long time ago, I adopted an old Mark Twain saying that if you always tell the truth, you don't have to remember what you say. And to me, this is the truth. Whether or not it turns out to be right is another question, but it's clearly what I believe.